right, Jason, welcome to episode number 6.
Episode 6.
And if we haven't been experts by now, 6 episodes in, that makes us
I think
experts.
so. Yeah.
By far, I know we said it the other day, because what were we, like 2 episodes in? We thought we were experts?
Yep.
Now, I definitely feel like the
For sure.
expert.
I think we were probably above the average amount of episodes that somebody's done a podcast.
For sure.
Yeah.
Yeah, we're on a roll.
Yeah.
So, hey, today's episode, I love the title of this because it's the golden rule, not the, treat others how you'd want to be treated, but R. Nelson Nash kind of spun it a little bit.
Yep.
Those who have the gold, this is the golden rule, those who have the gold create the rules or make the rules, right? So we're just taking it right out of the book, Becoming Your Own Banker.
Yep.
And page 31 through like 33.
Quick and easy.
Quick and easy. But there's some things that we really want to talk about, in this, and why we as an American society have kind of gotten away from this concept, and we need to get back to it.
Yep.
So this is something I hear Dave Ramsey preach all the time. He talks about Proverbs 22:7, and it says, "The rich rule over the poor, and the borrower is servant to the lender." So I can honestly say that is true. I mean, it's in the Bible, so it's got to be true to me. But I've lived that, right? I've had a car repossessed. I've lost 76 properties to the bank foreclosures back in 2008 during the crash. So I know that the borrower is definitely slave or servant to the lender. And I hated that feeling, and I don't ever want to go back to that.
Yep. Well, I'm sure you don't. I think for a lot of people, there's that thought process of, I'm tired of having terms dealt to me. I don't have any say on how my financial outlook's going. Well, because you don't have the gold, you don't have the capital, this is why you're not able to make those rules.
Yep.
So R. Nelson Nash was definitely a very smart guy. And for him to have this as a thought doesn't surprise me.
Yep.
For sure.
Looking back to my real estate days, I don't know how many times I was sitting with a buyer at the closing table and them getting just frustrated with the stack of loan documents that they have to sign. And a lot of it was very, duplicate type forms and everything, saying the exact same thing. And I don't know how many times I said, look, here's the deal. If you want the bank's money, you sign the bank's documents.
Yep.
I mean, this is the only way. If you choose not to sign one document, you don't get their money and you don't get the house.
Yep.
So that's a prime example of how, the bank dictates the terms on everything. There is no negotiation with the bank.
Yep. And you can't blame them either. I mean, if you had $200,000, $500,000, and you were going to loan it to somebody on a mortgage, you'd be asking the exact same questions. You'd be filling out or having them fill out the exact same documents and paperwork and all those type of things too.
For sure.
To protect yourself.
Yeah.
And so you can't blame the bank for wanting to do those things.
If you ever get tired of the bank making all the rules and you feel like other people are getting all the good deals out there and you're just missing out, it's because you don't have capital.
Yeah.
Right? And so that's what we want to get into on this. So think about all the things out there that you don't have a say on. I mean, just name off some examples that you can think of.
Well, so yeah, the mortgage that my wife and I have, we still have a mortgage. Prior to us getting our mind wrapped around money and the way that money's used, it was our car payments. It was student loans when we still had those. There's tons of aspects that influence your life, money in, money out, that other people are dictating how that money flows.
And I think our society, now that I'm just kind of thinking about this as we're talking, our society's kind of built on you have to do it this way, because if you don't get a bank loan, then it doesn't help your FICO score, your credit score, right? Or your social score, as I call it, because they literally control how you act based off your score.
Yep.
for the normal person, you feel like you kind of have to play by their rules and there's no way out of it. And it's just the way it is. And I need this credit score so I can get good terms on a loan on stuff that, I could tell you if you've ever lost a vehicle. I've had a vehicle repossessed. That sucks, right? Like I said, I've lost a lot of properties and everything. You just kind of hit the point where it's like, enough. I don't like this game, and I don't want to play it no more.
Yep.
Right.
For a lot of people, they feel like there's no way out, and there is a way out, and you can have control over that, most definitely.
Yeah.
And so, if anything, by having this conversation today, hopefully you feel that there is a way, and maybe encouraged to start taking some steps and not having everything dictated to you.
And like we said before, this is not going to happen overnight. This is a process. But there's only one way to eat an elephant, right? It's one bite at a time. And so that's what we're trying to do here is draw the line in the sand, say enough is enough. I'm done playing by society's rules. I want to create my own rules, and I want to escape this way of thinking.
Allie and I have a different way of thinking now, where ideally my goal would be that I could care less what my credit score is because I've stored up enough capital that I don't need to worry about what my credit score is if somebody will lend me money. It's because we have enough cash flow coming in from all of our investments, all of our assets, and I'm not going to have to go borrow money. Have to is the big difference between getting to choose to borrow somebody else's money. And so that's where our mindset has shifted from that. So it's a radical thought in today's society for sure, because a lot of people can't have that opportunity. That's why if we want to live a different life, that's where we're going to go towards.
But Jason, if you don't have a credit score, what about how the insurance companies on your car? What about that? Won't that increase your premiums on your car?
It very well might, but if our cash flow has increased, we're at such a positive cash flow. But also, there's some thinking of, well, do I really need to carry the type of coverages and such that I have if I have that money sitting back in reserves? Thus, does that actually lower my expenses and such when it comes to insurance? So
That's a good point.
Different way of thinking.
It's a good point.
And that may not be for everybody. But if you have those reserves, you don't have to take or push that liability per se on the insurance company. Thus, they're not going to charge you for that liability and risk that they're taking on.
Yeah, because when you're talking like car insurance, you got collision, comprehensive, all that liability, and all you're doing is transferring the liability of replacing the vehicle onto the insurance company. And there's state minimums that you have to have and everything like that, basically to cover other people's vehicles if you run into them. But on top of that, you don't have to have all the comprehensive and all that kind of stuff if a tree falls on your car. Your mindset. I'm not saying that I'm at that point yet where I feel comfortable.
And I'm not either.
But but we easily cash flow the insurance policy. And so, but who knows if I had 10 times the amount of money sitting around and I could easily just be like, okay, I'll just write a check. That one's gone. I just lost my truck. I'll go buy a new truck, whatever. Do I need to spend that kind of money? Here's an interesting quote. I was reading through the book the other day, and so I came across this quote. R. Nelson Nash says, "The common man has become so infatuated with living for today that the importance of saving, creating capital, is all but a lost value." And so I was like, is that really true? So then I looked up what the savings rate was. Take a guess on what the savings rate was for Americans in 2024, just last year.
Ideally, you're told, 10 to 20%. I bet it's not even close to that.
Dave Ramsey said you need to be saving 15%.
So I guarantee it's not even close to that.
So according to U.S. Bureau of Economic Analysis, the U.S. personal savings rate for 2024 was 3.8%.
I could see that for sure,
That's
which is not nearly enough.
That's not a whole lot.
No, it's not.
No, and that I'd say that's the reason why, we talked about the other day where to live off $50,000 a year in retirement, and this includes Social Security that you and I are concerned about, you got to have 600 grand. And most people at 65 only have 200 grand.
Yep.
This is, right here. You're saving 4%.
Yep.
The average American is.
Yeah. For a lot of people, they've been falsely given a sense of security from the fact of they continue to put pennies in and figure that they can get dollars out later on. And the growth inside these traditional government retirement plans are not coming to fruition on what they've been told.
Yeah.
And so nowhere in life do we think, man, you put minimal effort in that you're going to get an amazing result after the fact, except for government plans. We've been told that.
401ks.
Yeah. And so, if you keep putting pennies in, you're only going to be able to get pennies out later on.
Yeah.
And so you've got to change your thought process on, I need to put putting more. And when we say savings, so we need to be important to maybe make this designation. We're not talking about, having money sit in the savings account by any means. When we talk about savings, we're talking about saving capital, which when you start thinking about it, capital is an amount of funding that you can then use for investments to increase cash flow, increase wealth, all those type of things. That's what we're talking about in savings. It's not like Allie and I, we do have a little bit of savings inside of a credit union here in town.
For like an emergency.
For an emergency, whatever it is. I would argue our savings, though, our life savings, is not at our local bank down the street.
Neither is ours.
And so maybe we need to talk about that a little bit, is we're talking about storing capital for opportunities when we're talking about savings here.
Yeah. Yeah. So we want to create a fund. And most people, let's just make this correlation. Most people think, I'm going to save for retirement. I'm going to put my money in a 401k or a Roth IRA, right? Or traditional or Roth IRA. Those are what people think of for retirement. You and I think differently. We don't want to go into partnership with the government.
No.
We think they're the worst partners out there.
They would be a horrible business partner.
Horrible business partner, where they take a majority of it at the end, right? Well, depending on your tax rate. But here's a funny thing. What other plan, I know this is off topic, but what other plan in the world says, hey, let's do all this planning and everything for you to be in a lower tax bracket when you retire? Yep. By essence, you're saying we want you to make less money when you retire than what you're used to making now.
Yep.
Who came up with that concept? And how did they even...
Well, Wall Street came up with it to try to justify what they've been having people do since the mid-'70s, when Wall Street wasn't the place where people were storing their life savings. And so they had to come up with some type of math equation to get you to do that. But I think just inflation itself debunks that thought process.
Yeah.
Because I know the difference of what it cost me to feed my family here in 2025 compared to what it did just 5 years ago, or the fact of how my mortgage has gone up because of taxes and such in the last 5 years, and how my escrow, I'm contributing to that so much more when it comes to my mortgage payment. And so I think just by looking at that, there's no way you're going to be able to live off of more money, especially like at my age here in 25 or 30 years. If I was going to do the typical retirement thought process, I'm going to need more money to live off of in 30 or 40 years. Thus, in that thought process, I'm going to have to pull more from my account and thus paying more taxes than what I would be paying on those funds today.
So if your thought process is to get into a lower tax bracket because you're going to take less than what you're currently taking, you're automatically, in my mind, set up for failure.
I believe so.
Do we think things are going to get cheaper down the road or more expensive? I know for a fact they're going to get more expensive because we're on fractional banking system. We're not backed by a gold standard anymore. And so, there is no value to the money except for what we dictate it's worth. When I was talking with my wife the other day, we were looking at housing, and her real estate business and everything like that. And we were talking about, some of her clients are like, hey, when I bought this house, it was, $400,000. Now it's $1 million house in Wichita. And that's just insane to us because we've been in the market long enough. We don't see these homes as these big $1 million homes. We still see them as what they originally were. And I actually saw some research the other day. Kansas, overall, the average home has increased 54% since COVID 2020 in 5 years. 54% increase in value. So, I'm not saying we're going to continue to have that growth because it's starting to get back down to normal. But, I mean, think about it, in the next 20, 30 years, are we going to have another instance where inflation kicks in? It happened back in the 80s really bad. So that was 40 years, right? So I don't know. But, so when we're looking at what the wealthy do, because that's really what we want to look at, right? The wealthy, they have reserves of capital. They build up reserves of capital. They don't trap their money in government-backed, plans and where they don't have access to them. And so that's what we want to do here. So talk a little bit more about that.
Yeah. So, the average day American are locking up funds inside government plans, 401ks, Roths, whatever they are. And deals are coming across. They find something, whether or not they have the knowledge base to contribute to a deal, or maybe they do have $250,000, which would be unusual. But let's say they had, 6 figures in a 401k. Well, that opportunity is going to pass them by because their thought process is, I can't get a hold of this because I'm going to have a withdrawal penalty because I'm not 59 and a half. And all of the taxes that I'm going to have to pay on those funds and such. Well, now that's another opportunity gone and by. 4 or 5 years down the line, they keep throwing money into a 401k. Another deal pops up. Maybe their neighbor's house comes up available for a great, sweet deal that could be an awesome rental for them or whatever it is. They miss that opportunity because they've been continuing to put money into a 401k. The wealthy are not doing that. They're investing in businesses. They're investing in cash flowing assets. They're having a pool of money off to the side. So if property comes available, or if their competitor is ready to sell their business, they're sitting there ready to take advantage of that opportunity. And so they are saving money off to the side to take advantage of that.
And it all go. I know there's some probably listening and be like, well, yeah, that's good for them because they're wealthy. But they didn't start that way.
No, I mean, don't get me wrong. There's people that are born into wealthy families and they're given, but that is few and far between. And I think with the way you see individuals pass on from generation to generation, it doesn't last as long as what you think because they're not very smart on how they're passing that information on.
Wealth, the majority of wealth is diminished within 3 generations.
Exactly.
So, we want to create a structure where that doesn't happen. It multiplies every generation, right?
Exactly.
So that's why with our policies, the beneficiary of those policies need to be trust. And then you have rules in that trust on how that money is to expand, right? What that money could be used for. So, I was looking just the other day, and from when we started our policies in 2022, I started tracking it in February 2023. And between all our policies, we have a death benefit of about $6.9 million, right? Which is crazy, right? When you think about now, because we've paid into it and our death benefits have gone up on all our policies, it's now $7.7 million, right? As of just a couple of days ago. And so it's almost gone up $1 million. Now, it might sound like a lot to some, might not sound like very much to others, right? But my thinking is, that is for the generations in my family. I started from nothing, right? My kids will have it better than I do. Hopefully their kids have it better than they do. That money is to help jumpstart generations in my family to come. Right? And so, but we got to start somewhere. Unfortunately, I was the one, my wife was the one in both of our families where we said, hey, we don't like how you guys, not anything against our parents, but we don't like that way of thinking. Right? When you hear savers or losers and all that kind of stuff, it depends on what kind of savings you're doing. If you're just tucking your money away in a in a traditional savings account and you're losing to inflation or you're paying extra on your mortgage, which, by the way, next episode, right? So rushing to pay off your mortgage is actually destroying your ability to create wealth.
Yep.
We'll talk about that.
Yep.
Right. And that's going to be against the grain of what you've been taught. But, you got to start somewhere. And so we decided as a couple that we are going to change the trajectory of our family tree. Right. And we're going to not do what our parents did. And so we started with one policy.
Yeah.
And it was already money that we were saving anyway. Right. But we just decided that, hey, we're going to store our capital somewhere else where we have access to it, where it grows uninterrupted compound interest for the rest of our lives, where it's protected, right? It's a private contract. Oh, by the way, we get dividends on top of that. Not guaranteed. Throwing that out there. But they've never missed a dividend paying or a payment in over 150 years. Right? So there's so many more benefits. Oh, and the rate of return on this policy compared to a traditional savings, account at the bank is like 4,000% more. It's insane. Right. So
I think the biggest thing is the access to capital and you being able to start dictating rules. And I think it goes back to the comment that Nash made is that is what's providing people the opportunity to continue to grow is access to capital, having capital intentionally, systematically set aside to take advantage of the opportunities. And the majority of Americans are not setting that capital aside. They may be saving, but in the worst possible places, and they just cannot take advantage of the opportunities.
Yeah, it's just something that you just got to do. So if we were going to start something today, what would you recommend? Where would we put our money? Where would you put your money? And what would you follow? What steps would you follow?
Well, so, first and foremost, it's, finding the right storage vehicle, and we've talked about it a few different times already. It's a properly structured whole life, high cash value policy that's structured properly. And then you'll come to find out as you have cash available, opportunity, it's amazing. And I heard this several years ago and I thought, no, they're not going to show up any more than what, because I hear of opportunities here and there, but it is amazing how cash finds opportunities. Because, you would look back and go, man, how does Joe always find the good deal? Well, come to find out, Joe had cash sitting on the side. Now, yes, it's growing, but Joe had cash. And it's amazing when people start to find out that you have cash sitting around, how they'll come to you with opportunities wanting to partner with you. And it's true. So you've got to be able to start foundationally with the right type of an account, right type of policy, start storing the cash. And then I would say step 2 is being intentional, knowing that cash is sitting there. Your thought process is, I got to get this cash to work, right? It's not quote unquote in Wall Street anymore. So it's not growing is maybe what you're thinking, but that is not the case. But that's what traditional people think. And so that desire to make that cash grow makes you go out and seek opportunities. I would also let people know that you're seeking opportunities and they will start reaching out to you. And then the great thing is, I would say step 3 at that point is learning the ability to say no, which sounds really, really crazy, but you've got to get really good at saying no because every single deal thrown at you is not going to be a good one.
Not every opportunity
is a good opportunity. I would say actually the majority of them are great opportunities for you to lose that capital. And so, being able to say no, being able to start looking and seeking people that have found good opportunities in the past and asking them, what did you do to vet these opportunities? Would be a next step after that point. And then, after that, it would be being excited about that, educating yourself on whatever particular opportunities you are finding, because there's not a such thing as a bad investment, I would argue. There's just really bad investors. Because I know people that have invested in really good deals and have lost money still because they didn't educate themselves on how that deal works, what's the exit plan on that deal, how's the way to protect myself in this deal. But I've known people that maybe didn't have the best investment starting out, but they educated themselves on how to strategically place that, how to work that deal, and they came out on top. And actually, it became a great investment because they were educated.
Yep.
So those would be the steps that I would take.
No, I completely agree. The first thing, you just got to look at where you already are putting your money, and then ask yourself, can I change one thing? And that's, instead of putting my money here, can I put it in a properly structured whole life policy to store there and then go do what I want? So you're doing both, right? It's an and asset, right?
Yep.
There's a great book on that called The And Asset.
Yep.
And so it's not one or the other. We talked about opportunity cost earlier in the podcast. If you put your money somewhere, you can't then do something else with it. In this case, you can. You could put it in this, store money, have all those benefits that we talk about with the whole life policy, and then at the same time borrow against that and go put your money into a great opportunity.
Yep.
And then the money that spends off of that opportunity goes back. It's just a circle. It just replenishes the policy loans that you take out, and you're building your wealth again, right?
Yep.
And so, yeah.
Not only for a lot of people are they storing the money in the wrong places, but then you're then at the will of others. So I would argue what you're doing is now you're providing yourself the opportunity to make your own financial decisions instead of going back to the golden rule. Because you don't have the capital, now you're at the mercy of other individuals. And I've had many business owners, whether it be, your traditional sense of a business, or whether it be a rancher or a farmer, you hear stories of, hey, I wanted to go out and buy this other 100 head of cattle, or I wanted to go out and be able to buy this extra 100 acres or 1,000 acres, whatever it was, but I didn't have the capital stored. And so I had to go to the bank and ask, and they told me no. And that opportunity to be able to increase my herd, because I needed to make that deal to make my business more profitable, or to be able to pass on what I wanted to pass on, but the bank told me no. I've heard that story way too many times.
Yeah.
And so people need to be able to start storing capital off to the side to where they can make those decisions for themselves.
Absolutely. Well, I love talking about this one. I can't wait to talk about the next one because it goes such against the grain of Americans' way of thinking.
Yep.
And, my mom is this way. I got to pay off my mortgage as fast as possible. I got to put everything towards the mortgage. And we're going to talk about why that's not a great idea and why it's actually killing her from a wealth building standpoint. So, anything else before we call it?
I don't think so.
All right, man. Well, I appreciate it as always. And don't miss out on the next one because we're just going to enlighten the mind just a little bit.
That's my goal, I think, with every single time we sit down, is just to get people to have a sense of wanting to learn. Yeah. I think that's the biggest thing for sure.
Like we said in episode 1, keep an open mind.
Exactly.
So, all right, man. Hey, it's good to see you again.
Yep, for sure.
And until next time, guys, we'll see you.